Hi everybody, welcome to another update on Stock Screener. Today we're going to talk about SM Energy, just another company that I found on YouTube. I wanted to look at it and see if it's buyable. So I've never heard about it, so let's do it. PE of 5 looks very promising. $6 earnings, yeah, PE of 5 to 7. Let's see if this has any upside. So I have my calculation sheet ready, and the NPV chart is also ready. So let's start with the balance sheet. 10Q. So we have diluted common shares outstanding 120 million. 120 million. Share price 43 times shares. So $5 billion market cap, and the balance sheet tells me 678 million 678 million in current assets, actually minus. Then we have, so I don't assign any value to these things. These are non-current. Non-current assets. These are current assets. Of course, you could sell some of the properties, but yeah, it's typically non-current. Then we have total liabilities, 2 billion liabilities, a lot of debt, taxes to be paid, other things, and these are the payables. Okay, so 2.1 billion. So enterprise value of 6.5 billion. Okay. Next, we look at the production. $14 million BOE for the second quarter, or 154,000 BOE per day. 154,000 BOE per day. Let's do this. 154,000. That's annually 56 million per year. That's possible because they had 14 million BOE in the second quarter. Times 4 is 60, yeah, 60 million BOE per year. So 154,000 BOEs per day times 90 days is 13.8. Why is it 14.1? Why is it 154? 154.4. Second quarter, yeah, 91 days. 14, 14 million. Yeah, 14 million indeed. So we have 154.4 BOEs per day. 42% oil. 42% oil is mostly gas then. They have oil, gas, and natural gas liquids in Texas, repurchasing shares, reduced expected capex, 309 capex. 309 capex. And they are reducing it by 50 million. So let's say 266 per quarter in capex, which is still 1 billion capex. That's pretty high capex. They did an acquisition for 1,000 BOE per day. That's not a lot, 150,000 and only 1,000. No, that's nothing. Production by operating area. Okay, so we have this is a number, 1,000 barrels per day. So 64.5 thousand times 365. That's the production of oil. 64.5. Then we have natural gas, 370,000 MCF, because this is MMCF, 370,000.4. This is in MCF. Then we have Yeah, mm is million cubic feet, so mcf is 1,000 cubic feet. Then we have natural gas liquids, 1,000 barrels per day, 28.2. Thousand. So that's a total of 154.4 thousand. Gas price is 2.7, I think, currently. Oil price, this is oil price, is about 83. Natural gas liquids was, I think, 25 or something like that. It was 38 CAD. So it's about 28 US dollars. Okay. Texas, I think they get WTI prices, right? South Texas, $70 in the second quarter. What was the price in the second quarter? About 75. Yeah, it's about 75. Natural gas, 1 point. Oh, here it's 1.7 and here it's 2.5. It's about 2.5, between 2 and 2.5. Yeah, 2.5, 2 to 2.5. Now it's 2.7. Let's just use 2.7. Natural gas liquids 21.4. Yeah, it's about, let's say 25. Okay. Let's look at SG&A. So we have the revenue. SG&A is 27.5. 27.5 times 4. And then we have interest expense. They have debt. So 22.15 times 4. Taxes, I haven't even included taxes, so I'm just looking at the cash flow. But yes, we need to include taxes. Taxes are 40 divided by 191. Is about 22% tax. So what I'm going to do is here, tax in the free cash flow times 1 minus tax. Okay. After tax. Yeah, this is just the gas price. Royalties. Do we have royalties? No royalties? Hmm. Not sure why there's no royalty. We have production expense. So what's the production expense? Actually, we can just calculate that. It's 145.6 million is 145.6 million. That's the cost per barrel. And we have this amount of barrels. Gives me a cost of 2. Uh, okay, this is per quarter, so we need to do this is per year. So divided by 4. $10. $10 cost per BOE. Is that possible? Yeah, the earnings are 550 million and very low costs. About 30%, less than 30% costs. So what was the revenue per barrel? $40. $40. So $40 and the cost is $10. So 10 divided by 40 is about 25%. That's the cost. If we look at here, then we have 145 divided by 550 is, yeah, it's the same. So that's the cost. Depletion I don't count because that's not a real. Is that a real cost? Depletion? I don't think so. You don't lose any cash with that, so I don't care about that. Exploration. $60 million. Well, that's let's add it to the G&A. 15 million. not a lot. Okay, so we have our production chart. This is $40 Q2. Netback is this minus this. $30 netback, very high margin. Royalty, I have not found anything about royalty. Let's see if the revenue matches up. $40 times 154. 154 per day times 91. So I should have I should have 560. Yeah, 560 here, it's 550. 40, 154.4. $562, but I get 550. So there's a bit of less revenue. How much? Maybe 90%. 505. No, not 90%, 95%. No, it's just a tiny bit. 98. So let's say royalty 2%. Okay, so now we have calculated everything in with capex. And when we look at this, 5 times free cash flow after tax, then we get a PE ratio of price to free cash flow is this divided by this 10. 10 PE ratio based on this calculation. All the revenues added minus all these costs. Yeah, this should be 1 because we are using MCF, not gigajoules. Yeah, US dollars per MCF. And conversion factor 1 because we are using MCF. Anyway, the price to free cash flow is still 10. Taking everything in account. Let's confirm that 149.8 is 150 million. So times 4 is 600 million. And the market cap is 5160. Something does not compute. We have 10p free cash flow, but here it's 9. Not sure why. This is only 4. Maybe the 157 here is not that high. Anyway, I'm just going to use my numbers based on these capex. So it's about price to free cash flow of 10. Production BOEs per annum is this number. Let's say it stays constant. All-in sustaining costs 10.33. And that's per barrel, so times so the cost is this times the barrels. Capex is 1064. So 1 billion capex. Interest payments 88.6 million. Yeah, the oil price that they use is 40. And 40 was for the second quarter. But currently the oil price is already 20% higher. 15% higher. So let's say this is going to be 15% higher. That's 46. Interests, they do have debt. 1.5 billion in debt, so quite a lot of debt. Net income only 600 million. So they need about 4 years. 4 years to pay off debt. So let's do interests. Maybe next year it's 60 million, 40, 20, and 0. Tax rate was 22. Revenue is, yeah. I think we're done here. Let's look at the NPV chart. Okay. What's this? PE of 10. I don't like this company actually. With a PE of 10, maybe even PE of 8. You are not going to go to that enterprise value soon. Enterprise value of 6.6 billion. Okay, you can get some dividends out of that. Dividend is 2%, but that's it. Am I going to buy this company looking at this cash flow? I don't think so. It is very high quality, yes, high margins, but let's take a look at the leverage. What's the leverage against oil? So currently we have 480 million. What if oil goes up by 50%? Then this goes to 120. This goes to 4. This goes to 40. Let's say 35. Then we get to 1362. So that's the leverage. $1,362. So leverage is 1,362 minus 483 with a 50% increase in the oil price divided by market cap times 2. Something is not right here. Why is the leverage just 0.34? That's not a lot of leverage. So if we go up by 50% in oil, we go up by 1 billion. How much is this? This minus this 800 million. So you go from 5 billion to 5.8 billion, which is a 12% increase, 15% increase. Yeah, the leverage is actually below 1. That cannot be true. Let's do this again. 120. I mean, there's plenty of leverage. Oh, okay. I see the problem here. I use the change in free cash flow. I actually need to use the change in market value. So we start in 2417 and we do this again. 4, 120, 35, and we go to 6812. So 6812. I knew something was wrong. 2, 4, 7. Okay, leverage is 1.7. Not bad. There is leverage to the oil price. 2 times leverage. But price to free cash flow is pretty high at 10 or 8 to 10. It is a bit overvalued currently. I like to buy things at 5 times free cash flow, not at 8 to 10. But okay, if oil goes up to 100, then it's a pretty good company. With leverage to oil and gas. And you can see that here as well, if we do times 1.5, if oil goes up 50%, then we get the following situation. Then everything changes. If oil goes to 120, then the cash flows will come in very fast. So you need to get the oil price right. Is it going to go to 120? I don't know. Let's see something about the growth. We have not looked at the presentation yet. I don't even know if they have a presentation. Okay, here is the presentation. Let's see the growth. Well, I'm not an oil engineer. I don't know what the growth is. They need to tell me. And I can't find it anywhere here. Okay, we have some numbers. 10 to 13 years. 10 to 13 years mine life. 13 plus. So you can add some more years to this. And some more years to be added as well. Capex 1 billion, yes. Production 53 million, yes. 56. 40%, yes. G&A 120 million, 60 million exploration. Yes, 180. Yeah, I think the numbers are correct. But I don't have the growth yet. What is the future growth? If they don't tell me, that means there's no growth. It's that simple. Because they don't want to show me. Okay, so there's no growth. So basically, production will stay stable and probably come down a bit. And this is going to be your cash flow. With, of course, maybe 5 years extension. I don't know how much, but it will never get to this enterprise value. There's too big of a gap here. And of course, it depends heavily on the oil price. If the oil price goes up, I agree that there will be a lot of cash flow coming in. And then the valuations can rise. But this, at the same time, if oil goes from 80 to 70 and back to 60, for example, like this, 44, 42, 40, then you get this scenario. And that would not be a great investment, because the EV to net income would be this divided by this, would be 27. Not good. And today it's this divided by this, much better, 15. So that's the assessment. If you like oil and you think oil is going to go to 120, then buy it. But when oil stays at 83 today, I would not buy this, because there is not that much of upside. It's overvalued on my valuations of 5 times free cash flow, and I have better things to buy. Now let's do something. Maybe natural gas goes back to 4. Let's see what happens. Yeah, not that much leverage to natural gas. If it goes to 5. No, it's not that leverage to natural gas. It's more the oil price that changes it. Yeah, if oil goes to 100, it rises a lot. If natural gas liquids go to 35, yeah, it's not that much. So this is more leverage to oil, a little bit leverage to gas, and not leverage to natural gas liquids at all. Okay, that was the assessment. Interesting company, but not for me. And I'll see you in the next video. Bye.